So Alphabet. It's structured almost like three totally different companies, isn't it? Just sort of glued together.
That's a good way to put it, yeah.
And when you look at their financials,
Hmm.
the real challenge isn't just knowing what they own, it's figuring out why they report things the way they do.
Exactly.
Our mission today, really, is to take the source material we have and kind of map out the strategic thinking behind this huge global structure they've built.
And it is huge. I mean, just for context, Alphabet itself was incorporated back in 1998. Headquarters are still in Mountain View, California.
Right, Silicon Valley.
But yeah, the operations, they're everywhere. US, Europe, Middle East, Africa, Asia Pacific, Canada, Latin America. It's a massive footprint.
That geographic spread, it really mirrors the complexity inside the company, too. So, okay, what's the main way we should look at this financially?
Well, the sources are pretty clear on this. They organize everything strategically into three main reporting segments.
Okay.
You've got Google Services, Google Cloud, and then this interesting one called Other Bets.
Right. And that framework basically dictates how they present everything.
Pretty much, yeah.
Okay, so since, cash generation fuels everything Alphabet wants to do, let's start with the segment that's really their engine. Google Services. This is the massive consumer side, right? It covers things like ads, search, YouTube, Android, Chrome.
Devices, too.
Devices, Gmail, Google Drive, Maps, Photos. Essentially everything most of us touch every day.
Yeah, that's the strategic cash cow. And it's really important to see that the revenue here is, well, it's way more layered than just search ads.
Although those are huge, obviously.
Oh, absolutely massive and high margin. But services also includes revenue from selling devices, Pixel phones and stuff.
Okay.
Plus sales of apps, in-app purchases, digital content through Google Play and YouTube, and YouTube's own consumer subscription services.
So it's built to be this really profitable machine that can fund everything else?
That's the design. It funds the future risks. Now, connecting that to the bigger picture, you then shift over to the high-growth enterprise engine, Google Cloud.
Right, the B2B side.
Exactly. This is where they provide these complex cloud-based tools mainly for enterprise customers. And their focus here is really competitive.
How so?
They're leveraging really sophisticated offerings, things like specialized AI infrastructure, advanced cybersecurity tools, deep data and analytics solutions.
And crucially, that's where a lot of the big AI investment comes in, isn't it? Like the Vertex AI platform.
Yes.
That's not just some technical term. That's their whole integrated machine learning and data science environment. It's how they compete directly with like AWS and Azure.
Absolutely critical for that enterprise space. And, following your point about integration, most people use Gmail or Docs just casually, right?
Yeah.
But Google Workspace, Calendar, Docs, Drive, Meet, all those cloud tools, when sold to corporations, that's actually a cornerstone of the Google Cloud segment.
Ah, okay. So its inclusion there really shows how they're pushing to capture that whole corporate digital setup.
It's a unified push, definitely.
Which brings us then to the third segment, the one that represents, well, pure risk and maybe the long-term future. Other bets.
That's it. This is where they pour capital into projects that might take a decade to show any return.
Or might just fail completely.
Or might fail, yeah. You're talking about massive ventures here. Things like Waymo, their self-driving car project, Verily, which is their big healthcare and life sciences play, and various internet connectivity projects, like some of the stuff spun out from the old Loon project.
Okay. What's interesting there, though, is how they report it. It seems strategically separate.
It is. It's deliberately separated to maintain transparency for investors, for shareholders. These projects, which right now mainly sell some healthcare-related services and specific internet services, they consume huge amounts of capital.
Their capital sinks.
For years, often with zero revenue before they either get shut down or, if they succeed, maybe get folded into services or cloud eventually.
So splitting it out ensures that the volatility of something like Waymo doesn't mess with how people see the core profitable Google services business.
Precisely. It isolates the risk, financially speaking.
So putting it all together, what does this really mean for you, the listener? The key takeaway seems to be this three-segment structure is designed to enforce a kind of financial discipline.
That's right.
Services ensures the massive profits, cloud drives that aggressive high-value growth, and Other Bets lets investors clearly see the long-term, high-risk R&D potential separate from the day-to-day earnings bumps.
Yeah, the structural design is really the heart of the deep dive here. It lets them chase those moonshots without putting constant pressure on the core business model everyone relies on.
Makes sense. But, this structure does raise a pretty critical question about where they put their resources.
Yeah.
Well, thinking about the huge emphasis and, frankly, the investment we see pouring into the cloud segment's Vertex AI platform right now, you have to wonder, how much longer can Alphabet justify keeping massive R&D projects like Waymo parked in other bets?
It's a fair question. When does a bet become something more?
Exactly. And how will those healthcare and internet services currently listed under other bets, how will they ultimately shape Alphabet's core strategic direction, say, 5 years down the line? Definitely something to chew on.